Sidekick Accounting and your accounting sidekick. And today we are on series session 6, whatever you want to call it, episode 6 of Out of the Box Accounting. So Out of the Box Accounting is meant to help you understand how your accounting affects more than probably the obvious. And having these conversations and making it more understandable and relatable is hopefully going to be helpful to you as a business owner to encourage you to start digging into your numbers more. Because when we look at our numbers and we consider our numbers, it can help us to be more profitable and successful businesses. And I'm not just saying that because I'm biased and an accountant. The truth is that big businesses and successful businesses look at their numbers a lot. And the reason why is because they matter. It's because there is so much information packed into your statements and reports that you can pull that allow you to make better decisions as a business owner. So today we are going to talk about financing. Good debt versus bad debt. And this is a conversation that doesn't always come up, but it does sometimes come up. And I think it's an important one because when we think about financing, sometimes it can be a blanket thought, right? And sometimes when you're in the midst of growing, right, and you're in the midst of operating your business, you are good with whatever financing you get. But the truth is that there is good debt and there is bad debt. And we got to be aware of what that looks like as business owners and how it impacts your financing. So let's first break down exactly what debt is. So just in case you're not sure. So debt is basically when you owe people money, right? So there's debt that you can have from loans, which is probably the most obvious. Credit cards are another one. But then there are additional things like terms. And terms, when we say we purchase something on terms, it means that we purchased something from a vendor or from a service provider, but we haven't paid them yet. So that technically is debt. It's money that you owe to somebody else, that your business owes to somebody else that you're going to have to pay, right, at some point. And so when we talk about cash flow and cash flow management and kind of more of the CFO conversations, we talk about things like debt, and your debt to income ratio and, what you need to be considered in terms of that, because the more debt you have, the more it's going to eat your cash flow. So you got to be really careful with it and make sure that you have the right kind of debt and for the right reasons, because it can impact your business in such a huge way if you don't consider these things. So debt is when you owe money to people for different things. So some examples of what would be considered good debt could be loans, it could be terms, it could be lines of credit, it could be family members, right? Because you could potentially borrow money from family members to help support your business. And then some things that are probably considered more bad debt would be things like credit cards that aren't paid in the same cycle that you purchase things in. So credit card balances, I would say. Payday, well, they're not called payday loans for business, but it's basically the same thing. So there's a lot of businesses that I've seen have gotten sucked into a payday loan kind of a thing where they have to pay a certain amount every single day. And it doesn't seem like a lot, but that totally crushes your cash flow. And typically you're paying a high percentage of it. So it's bad debt. You really want to try and stay away from those things as much as possible. And then maybe owing money to the government, right? Taxes can be bad debt because they could really get you for that, especially payroll taxes. Not so much income taxes, but sales tax and payroll tax are definitely bad debt items that you really want to make sure you take care of, because not only is that bad for your cash flow and you get all this interest and penalties on it, they can actually do things like levy your account or put you out of business. So those are some of the bad debt areas that you definitely don't want to mess around with either. So understanding the difference between what makes good debt versus bad debt is really important to understand as well. So bad debt, like I said, with the taxes is really important. You get slammed with interest and penalties. They can put you out of business. They can take money out of your accounts. Typically, that is only for government related things. So sales and use tax or income taxes is typically when that's going to be, especially on the state side, because like Wisconsin, where I'm from, they're very aggressive when it comes to that. So you want to make sure that you're aware of what your state rules and laws are and how it affects your business and your taxes for your business and what you need to be compliant in. So understanding that is a big part of the debt piece for that. And then just making those payments on time. Like work that into your cash flow, work it into your budget, make sure that you're prioritizing those things because of the impact that it can have. But some other things that can help you figure out whether something is good debt versus bad debt is taking a look at the interest rate. So this seems like it would be pretty straightforward, but sometimes like when we're in a pinch, it can be something that we don't really consider, and that can be really impactful for our businesses. So taking a look at that interest payment and what you're signing up for when it comes to that loan process can be really, really important to making sure that you don't take on the wrong kind of debt. The other thing in kind of the same conversation with that is credit cards. So I have seen people finance their business with credit cards, which can be something that severely impacts them because along the same lines, they're paying this huge interest rate. And I understand that sometimes you want to get to a certain place and you want to get financing in order to get to that place. But I would challenge you to kind of take it from a different perspective. If you're in that place where you're like, I need financing, I need financing, I need financing, start thinking about why. Why do you need financing right now? Why can't you bootstrap whatever you're trying to do? And bootstrapping basically means you use whatever money you actually earn and make as like the net income for your business, and you use that to grow. So you don't borrow money, you just use what you have. And the benefit of that is that you don't get into debt because debt can be really overwhelming. And that's why I wanted to have this conversation, because if you have bad debt, too much bad debt, it's going to overwhelm you. Not just personally, but business wise, emotionally, stress wise. Like it becomes very overwhelming when you got to pay out tons and tons of money to people and your business isn't bringing in that money. So, depending on where you are in business and what you're looking to do with the financing, it might not be your best option. So you really want to make sure that you're considering these things and not just feeling like I need it, I need it, I need it, but really taking the time to see what the effects are for it. And I know this is probably a conversation some people aren't going to want to listen to, but it really is true. And it's really, really important. And I stress it because I've seen businesses actually go out of business because they had the wrong kind of debt for the wrong reasons. And it never ends up being what you anticipate it to be. And what I mean by that is like I've had clients, that we've worked with in the past that I advised not to, and they went ahead anyways because they felt like they needed X, Y, and Z. They needed X, Y, and Z. But instead of them doing the work on the front end, they were like, well, we'll just do that on the back end, right? We're expecting this X, Y, and Z, so then it'll be able to cover that. I have bad news for you. Typically, when you think something is going to happen in business, it's going to take a while longer. Like most things in business aren't going to be as immediately or as immediate as you anticipate. Like you can have great projections and great process, but there's so many other factors that go into different things that you really shouldn't bank on a certain thing happening because so much in life can change. The client can drag their feet, the product might have delays, it might get too much and your capacity is too small. Like all these different things can affect what is happening that ultimately hits your bottom line and your top line and your bottom line, which will impact what your cash flow happens. So if you have the wrong kind of debt, what it can actually end up doing is being more detrimental to you than good for you. And so you want to make sure that you consider them. Terms, how quickly do you have to pay it off? Interest rate, do you get a penalty if you pay it off quicker? those are going to be the bigger things that you consider. Additional impacts, as far as like, if you get a certain amount, or you have a certain amount of payment and nothing changes in your business, are you able to still support that payment? Those are some things that you want to consider. Like, what if you didn't make that sale, or you didn't have an increase, or you weren't able to do X, Y, and Z? How does that affect your ability to make that payment? And of course, that's going to be something that is part of the conversation, most cases, as part of the lending process. But that's also something that a lot of times, like those people that kind of just prey on business owners in a crunch, they don't consider as much, because they're going to be pulling so much money out so fast, that what happens after that for you doesn't really matter. And that's why they have such high interest rates. But it can really hurt your cash flow. And that's something to consider as well. How does that payment affect your cash flow? Because if it's something that you're going to have to pay once a week or every day, that is going to impact your cash flow in huge ways. And you want to make sure that you're aware of that. Now, an alternative that I see often is like a PayPal loan or a Square loan, where they take money off the top of your sales. But even then, if you're doing that, you may want to still have that conversation, or start that conversation with a traditional bank, or a bank with a line of credit that has a smaller interest rate, because your interest rate is going to still be higher on those items usually. So typically it's more convenient. It's coming right off the top of your sales, so you don't feel it as much, but in the long run, it's still impacting your bottom line, and you want to make sure that you're aware of that as well. So interest rate, terms, impact on cash flow, other effects like them being able to levy your account for state taxes, that kind of thing, how those different things affect you as well, are things to consider when determining whether or not it's good, bad, or debt, good debt or bad debt. And the biggest thing that I want to stress is take the time to think about the debt that you're looking to get into. Because I think sometimes it can just be in such a knee jerk reaction that we don't really consider all of the things. And so think about whether or not having some of these additional problems is going to be worth it for your business, or if it would be better for you to kind of take a step back and bootstrap, work on your profitability, work on your systems, work on your cash flow before stepping into acquiring debt. So some things to think about. As always, I'm here if you need me. Please feel free to join our free Facebook group. Our Find It Master Plan is our free session, the 30-minute session, to walk away with a tangible action item. And if you need help with your books, or you need to talk more about your debt situation, please feel free to contact us. We are here to help. We help owners organize, understand, and use their numbers to grow profitable and successful companies. So hopefully this was helpful. And like, share, tag, and all that good stuff. And I will talk to you again soon. Bye.